Hi everyone, welcome to Swissquote's daily market talk. So today we will be talking about the sell-off that we see in the US government bonds as some hawkish comments from the Fed members and some strong economic data smash the Fed's rate cut expectations. The US dollar gains, equities retreat, while Nvidia jumped almost 5% yesterday as Goldman Sachs upped its PT to $800 per share. So ready, set, go. So the sell-off in US bonds extended to a second day yesterday on the back of crowded comments from Fed members, including the Fed chair Jerome Powell on Sunday, who are now out there pushing back on overheated interest rate cut expectations from the market. And well, they're right, because the economic data actually continues to show a surprising strength for the US economy. And in this very context, on top of Friday's blowout jobs data, well, the latest ISM data that was printed yesterday show that the US services grew at their biggest pace in 4 months, screaming yet again that the US economy is just too resilient and just too healthy for the Fed to start cutting the interest rates in a hurry. As such, well, the US 2-year yield approached the 4.5% level, and the US 10-year yield flirted with the 4.18% level yesterday. For the 10-year yield, the past 2 sessions advance was apparently the second biggest advance since the Federal Reserve started hiking the interest rates in the cycle. And the US sovereign bonds are quite better bid this morning in Asia at the time I'm talking here, as the US 10-year paper is expected to see a limited upside potential above the 4.20% mark, but a March rate cut from the Fed has been taken off the table, and activity on Fed funds futures gives no more than a 2/3 chance for a May rate cut, which actually remains quite high still and could be further curbed. So this is where we are right now. So naturally, the US dollar extended its rally above the 100-day moving average and is roaring against all majors since, well, Friday's jobs data. But note that the other central bankers won't be sitting quietly, turning their thumbs moving forward faced with the rate cut bets. The Reserve Bank of Australia, for example, kept its policy rate unchanged at today's monetary policy meeting and warned that a further monetary policy tightening cannot be ruled out if price pressures persist and demand such action. They said that the cost of services is not falling quick enough. So the Aussie dollar found buyers below the 65 cents level after the meeting, but the 0.6530, 0.6575 area, which shelters the 100 and 200-day moving averages, will be quite hard to drill with the mounting appetite for the US dollar. And well, it's not only the economic data that says, stop guys thinking that the interest rate cuts will be a walk in the park this year, because the OECD also warned the global central bankers that it is certainly just too early to declare victory on inflation because, well, global growth remains resilient. And now they think that the global economic growth will slow to 2.9% this year from 3.1% last year, but that 2.9% is still above their November forecast. And well, not all locations have the same bright outlook, of course. And because traders and investors are more interested in the rate of changes in these forecasts rather than the actual numbers themselves, well, the changes matter. And if you look at the changes in these forecasts, the US growth forecast has been revised higher by 0.6 percentage points, while the Euro area economic outlook is down by 0.3 percentage points. So the Euro area's economic divergence, like negative divergence, compared to the US is due to its higher vulnerability to higher interest rates and, of course, the energy crisis, as Europe has no fossil energy, or most of it has not, and can't pump like crazy as the US does. And all that sums up to the same conclusion that I have been trying to convey since weeks now. The Fed is in a better position to keep its rates steady than the European Central Bank, and that hawkish divergence for the Fed should translate into a softer euro against the US dollar. So the euro dollar fell to 1.07 23 level yesterday as the soaring US yields and the stronger US dollar across the board hit all majors across the board. We could see the euro sell-off slow from here after a big two-day slide, but the euro outlook remains bearish as the economic data on this side of the Atlantic Ocean doesn't look as encouraging as on the US coast. And well, as I've been saying, it would only make sense if the European Central Bank started cutting its interest rates before the Fed, which would obviously imply a further euro weakness against the US dollar. So that's the basic thinking in the euro dollar. In the equity space, the extension of yesterday's sell-off weighed on major US indices, but not too much still, because the S&P 500 retreated by a meager 0.32% from an all-time high level, as Mama stocks eked out a small gain, while Nvidia gained another near 5% at yesterday's trading session because Goldman Sachs upped its price target to $800 per share. Now, note that Nvidia traded at the doorstep of $700 per share yesterday, so another $100 rise is, well, just peanuts at the current huge momentum, as there won't be much to stop investors from buying the stock in the coming weeks other than crazy valuation, obviously. But there's nothing to stop them before the February 21st earnings from Nvidia. So the question is not whether Nvidia could rise to or above the $800 per share level. It is whether it could keep these gains after the quarterly results. And well, you know what? I can't tell you that. What I can tell you, however, is when you have so much love and attention on you, you'd better avoid every little misstep, because look at Tesla. Tesla used to be the darling of the technology investors back in 2020, remember? When the stock gained around 1,600,000 between March 2020 and November 2021. Well, you know what? It's having a hard time since then. Of course, Elon Musk made big bets, especially by cutting the price of his amazing Tesla vehicles repeatedly to increase his market share in this fierce competitional environment. And unfortunately, well, the company finally came to a point where these price cuts that eat into its profit margins, well, couldn't increase the market share of Tesla enough to deliver the kind of income growth that the company was looking for. So for those who are asking where Tesla's stock price is headed from now, I would say that buying above the $150 per share level feels like catching a falling knife. Another place where buying feels like catching a falling knife is, well, the Chinese stock markets. The Chinese stock markets are actually in a better shape this morning at the time I'm talking here, as Chinese authorities came out with fresh measures to stop bleeding in these Chinese and Hong Kong stock markets. This time, China announced trade restrictions on domestic institutional investors and also on some offshore units. And also they announced some caps on some cross-border swaps that could be used to short the stocks in Hong Kong. And they also told some brokers, well, not to reduce their exposure to mainland Chinese shares. But guess what? All these measures are essentially attempting to turn the mill with carried water. And they have not been sufficient, or they have been quite inefficient to trigger a sustained recovery in stock prices so far. And they will hardly bring investors back on board, because the Xi government's led mindset change, the radical mindset change for the Chinese stocks, is the major source of the problem today. The government crackdowns that we saw on investors once gems like Alibaba and Tencent, for example, the destruction of that Chinese dream and the momentum and the broken investor confidence. These are the major problems that the Chinese stock markets or stock investors are facing today. So throwing money into the mix is just a clumsy quick fix, in my opinion. It won't fix the confidence problem. So, this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.